यार एडिटिंग टाइम पे आ जाना चाहिए बिकॉज 8:30 का डेड। अरे यार बंद करो यार ये सब, क्या तुम लोग भी ना। Right, so although today's video is not exactly about Top Gun, but it's definitely related, and a top priority for any country, including ours, is the defense sector. In fact, this Wikipedia page really surprised me, with half the countries on our planet engaged in some sort of war, conflict, or skirmish. Consequently, it comes as no surprise that the Government of India has identified the defense and aerospace sector as a focus area with the aim of achieving a turnover of $25 billion with an export target of $5 billion by the year 2025. Now, there's an old line that says war is good for business. It probably came from an American politician, but good or bad, in this video, we'll broadly examine the defense sector in India and also look at some metrics that can help us identify a potentially strong business for one to invest into. This is Kunal's first research piece, so your feedback and appreciation is more than welcome. And as Major Gaurav Arya says in all his videos,
इस वीडियो को लाइक करिए, हमारे चैनल को सब्सक्राइब करिए, बेल आइकन दबाना बिल्कुल मत भूलिए.
let's begin. Perhaps the best way of understanding how the defense sector is shaping up is by looking into the past, and believe me, there was not much to celebrate for a pretty long time. Our defense sector faced multiple challenges, and other than the usual budgetary constraints and bureaucracy, some of the more prominent problems included an overdependence on imports, which made us vulnerable to supply disruptions and changing geopolitics. Several foreign suppliers and governments imposed restrictions on transfer of technology and even export controls, especially on advanced technologies, making it very difficult for us to build a strong indigenous defense manufacturing base. There was little to none in terms of participation by the private sector, which limited innovation, efficiency, and competition. There was a lack of integration and coordination with the Army, Navy, the Air Force, intelligence, research agencies, weapons development, all operating in silos. And I can go on and on. There was an underinvestment in R&D. There was a lack of skilled workforce. We were using legacy systems, which all put together ensured that the Indian defense sector was always behind the 8 ball. Additionally, defense is a very capital intensive sector, and it requires a lot of money to design, test, and deploy a system. As an example, something which might seem so rudimentary, like the development of an onboard oxygen generation system for our fighter aircrafts, actually costs upwards of $150 million to develop. And finally, this sector has a rather long gestation period, and a waiting time of 5 to 10 years is just par for the course, because once a prototype is ready, it has to be tested by the armed forces, which takes 2 to 3 years. Suggestions are made for upgrades and replacements, and only once all this is done and the bureaucrats have approved everything does this go into the manufacturing stage, which is again a 3 to 6 year cycle. In fact, our former defense minister, the late Manohar Parrikar, was right when at a function in the presence of senior army officers, he said, "The Indian military's QR, or qualitative requirements for assorted equipment, seems to have appeared straight out of a Marvel comic book, as the technologies demanded were absurd, unrealistic, and fanciful." So this is where we were until maybe 2017-2018, but then everything changed, and over the last 4-5 years, the sector has witnessed substantial growth and transformation encompassing both public and private sector enterprises. So what changed? Well, firstly, a number of policies were formulated with a clear objective of indigenization, that is, India needs to reduce import dependence, and it needs to create an ecosystem for in-house manufacturing of parts, systems, modules, and weapons. In line with this initiative, and starting 2021, the Defense Ministry imposed an import ban on more than 2,500 items that were earlier imported, and these are now being manufactured locally. Not only that, there are another 1,238 items that are yet to be manufactured in-house, and this will be indigenized in a phased manner from now until the year 2028. Secondly, India's defense budget and expenditure has been steadily increasing to meet the country's growing security challenges and to modernize its armed forces. In numbers, the Ministry of Defense was allocated a little under 6 lakh crores for this current financial year, but more significantly, the IDEX, which stands for Innovations for Defense Excellence, was allocated 116 crores, which is 93% more than the previous year. Similarly, about 500 crores has been set aside to develop the latest technologies such as drones, image analysis, robotics, AI, etc., which augurs well for startups like Crone Systems, Asteria Aerospace, iRove, Optimized Electrotech, etc., who are already working in this space. In fact, there's a lot more focus on research and development, which is why DRDO is always in the news. But pleasantly, these R&D efforts are not just restricted to our shows, and the government and defense services have been actively engaged in joint ventures and collaborations with foreign defense companies to access advanced technologies like next-gen fighter aircrafts, advanced missile systems, unmanned aerial vehicles, and cybersecurity solutions. A fourth change in approach is in the form of increasing exports, and many countries across Asia, Africa, and Latin America are looking at India as a reliable defense partner. Some of the more notable names include Vietnam, which has acquired our Akash surface-to-air missile system, and the Sultanate of Oman is also interested. There is Myanmar that has procured the Varunastra anti-submarine torpedo, and then there is the Philippines and Indonesia that are keen on acquiring the BrahMos missile and other military hardware. To put all this in numbers, India's defense exports, which were a mere 686 crores in FY 2014, is now 23 times higher at about 16,000 crores, and we are still halfway from achieving our 2025 goal of 35,000 crores. And the final push comes from measured privatization, with the Indian government actively encouraging private sector participation in defense manufacturing. In the context of India, this is a big shift because defense was entirely a public sector activity, with companies like HAL, Bharat Electronics Limited, and Mazagon Dock shipbuilders being the notable manufacturers. And therefore, to show their commitment and to put its weight behind this initiative, the Ministry of Defense in FY23 set aside 25% of its total procurement budget, which is around 21,000 crores, towards domestic private companies. So to put this all together, we are seeing a policy-driven push towards indigenization, the thirst for innovation with IDEX and the development of a local ecosystem, a movement towards advanced technologies with the DRDO and collaborations with foreign defense companies, a notable increase in exports, and the participation of the private sector with establishments like the Tata Advanced Systems Limited, Larsen & Toubro, and Mahindra Defense Systems likely to take full advantage of that. But you know who else can take advantage? You, yes, you can take advantage and access a lot of research material and investment ideas by regularly visiting the blog section within the FISDM website. In fact, the team there has also independently compiled a report on defense stocks, which I'm sure you'll find very useful, and a link to that is available in the description section of this video. Now, when Kunal and I sat down to understand the different companies within the sector, what they do, the business model, how are they structured, how do they make money, etc., the one thing we realize is that you can't really compare one company with the other. I mean, on one hand, Hindustan Aeronautics Limited, for instance, is the dominant supplier of aircrafts, helicopters, engines, avionics, etc. for the Indian Air Force, the Navy, and also the Indian Space Research Organization. On the other hand, the second biggest company in this sector, Bharat Electronics Limited, is more into electronic warfare systems, communication equipment, radars, etc., which is a completely different ballgame. But having said this, we think there are 4 key areas that any investor who is interested in this sector should be mindful of. The first major consideration is the order book, and this term represents the total value of confirmed orders that the company has received from the Indian government or other entities. Understandably, the order book is the first step, and if orders are executed well, then it leads to realized sales, profits, and cash flows. Now, pleasantly, the order inflows across the sector have been growing at a steady pace, which has also had a visible impact on the revenue posted by many of these companies. In fact, except for BHEL, the Bharat Heavy Electricals Limited, most of the other companies took in their highest ever order book in FY22, and unless any of these companies do a harakiri with their execution, the future order book and the backlogs should give these companies a lot of buoyancy to their revenues. Of course, we have to be mindful of the fact that the overall business environment, the geopolitical factors, and the government policies do have a considerable influence on a company's order book. And with rising competition from private players, a growing order book is what we as investors should be looking for. as it not only shows that the company is winning new contracts, but it is also evidence of the confidence that buyers have in the company's execution capabilities. Now, the revenues earned by defense sector companies are a derivative of their order book. And because we know this, it becomes a lot easier to forecast where the company's financials are likely to be over the next 2 to 3 years. For example, Hindustan Aeronautics Limited HAL secured some major orders in FY22 which involved the delivery of 83 light combat aircrafts. This order was worth 48,000 crores, and obviously this would have found a mention in the company's investor presentation. But the interesting thing is that HAL will be delivering the first 3 aircraft, so 3 out of 83 will be delivered in the third year, so that's 2025, and then 16 aircrafts will be delivered every year over the next 5 years. Which means HAL today hasn't earned a single rupee from this 48,000 crores, and the revenue part of the order book will start getting realized only from the year 2025 onwards, when HAL delivers the first part of the consignment. My point is, if we as investors have an idea of what the order book is and when the deliveries are scheduled, then it's truly possible to make a reliable revenue forecast of the future. So here's a little homework for you. Now, in this slide here, I have included the key highlights from HAL's most recent earnings call. And what you have to do is to make an estimate of what HAL's revenue will be for the financial year 2025 and 2026. You can make assumptions, you can modify the details a bit, but the idea here is to understand and appreciate this process of forecasting revenues based on the order book and the delivery schedules. Now, interestingly, revenues for a defense company can be of 2 types. Firstly, there are product sales, that is the sale of helicopters, aircraft, submarines, artillery, weapons, etc., which is generally what an order book is all about. And secondly, there is revenue from sale of services, which can really boost up a company's financial performance. In fact, let's stick to HAL, and for the financial year 2023, the company declared a revenue of just under 27,000 crores. Of this total, exports contributed a mere 300 crores, development and others came to 3,000 crores, and here's the surprise, because manufacturing contributed just 4,700 crores, while the bulk of the revenue is attributable to HAL's ROH, that is repair and overhaul, and the maintenance services, which has been growing at a rather accelerated pace of 18% over the last 4 years. So it's a bit like buying a car, right? You've paid 10 lakhs for the car, the dealer has given you the keys, apne nariyal foda, but then a year later you realize that you have to send that car to the dealer every 3 to 4 months, and he charges you 15-20,000 rupees every single time. So MRO, or maintenance, repair and overhaul, is a bit like that, and while different companies will have a different split of product and service revenue, I'm sure we can all agree that this is an important piece of information for any investor when doing a revenue forecasting exercise. If you're getting good value from this video, then please do give this video a thumbs up. And if you aren't a subscriber yet, then do consider becoming one, as I can then serve you videos as soon as they are released, and also share with you some investing strategies, tips and stories that I continually post in the community section. Our third variable is capital expenditure, and it refers to the funds allocated for acquiring, upgrading or expanding a company's assets and capabilities. So think of it this way. Let's say you own a gun factory and you have one machine that can produce 100 rifles a day. You've been ignoring your manager's request for a second machine or a capacity upgrade of the existing machine for quite some time, which leaves you at a precarious position in case there is an order for an additional 50 rifles, or secondly, if your only machine starts giving you trouble and produces only 70 rifles a day. In other words, by spending some money on growth, research and modernization, defense companies can maintain a competitive edge, and they can also diversify and increase their revenue by developing new systems, improving existing ones, and by offering value-added services. A good example of this is Bharat Electronics Limited, which has been continuously focusing on sustainable growth by enhancing its R&D capabilities and by also modernizing and expanding its facilities. In numbers, BEL continues to invest about 600 crores every year, and for this financial year, this number might even reach 800 crores. Additionally, the company spends about 6 to 7% of its revenue on R&D, which is even higher than what HAL spends, who typically allocates about 10% of the previous year's operating net profits towards R&D expenses. Now, relying entirely on domestic contracts can make a company vulnerable to any fluctuations in government spending or in case there is a change in priorities. In essence, Indian defense companies should constantly try to reduce their dependence on a single market, and exports is one big way of doing that. Now, companies like HAL and BEL generate more than 99% of their revenue from Indian contracts, which shows a lack of diversification in the customer base and the segments in which they operate. On the other hand, a company like MTAR Technologies gets more than 80% of its revenue from exports, while the balance 20% is from domestic sales. Now, on the face of it, this might seem ideal, but when we look closer, we see that more than 50% of MTAR Technologies' clean energy segment revenue comes from a single company, which is again not good because instead of a geographical overdependence, the company now has a client overdependence. Of course, I have to add that this balancing act between clients and geographies is easier said than done in a sensitive sector like defense. But if we as investors were to identify such a play, then a higher preference should be given to the diversified company. Right, so other than the order book, sales, capital expenditure, and revenue diversity, an equity analyst would also look at other metrics like debt, profit margin, the return on capital, valuation metrics like EV on EBITDA, the company's free cash flow, etc. These are things we have sufficiently covered in previous videos on my channel, but specific to the defense sector, it is also important to examine certain qualitative factors, especially the part on regulatory risk, which is also something we have studied in detail in my video on PSU stocks. But on the whole, there is no denying that India's defense sector is grabbing a lot of attention on account of its healthy order books, revenue expansion, and the government's localization efforts. But as investors, we also need to be wary of steep valuations, execution hiccups, competition, and cash flow risks, which can easily dent this rally. I sincerely hope you now have a better understanding of the defense sector from a financial and investing standpoint, and over the coming months, I'll certainly want to do some follow-up videos on it. Once again, thank you for your time. Please do send in your feedback. I'm sure Kunal would love to hear from you. Do like this video, मेरे channel को subscribe करें, and I'll see you 3 days from now. Jai Hind.